So the most important thing that you're supposed to appreciate, ladies and gentlemen, is that CAPM, a very important model, assumes that all investors are who? They are risk averse. All investors are risk averse. They fear risks like nothing else. They fear risks so much. They fear risks so much. They fear risks so much. They fear risks a lot. They are risk what here? Averse. i.e., they are affected by systematic risk only. They are affected by systematic risk only. They are affected by systematic risk only. I would want you to listen to me very well. When we began this subject, we said that this is the risk profile. This is the risk profile. This is the risk profile of our investors. So there is a risk here that can never be reduced. There's this risk which can never be reduced. Who is able to remember this component of risk here that can never be reduced? Whatsoever you do, you can never go below here. Is there somebody who is able to remember the name of this risk which is uniformly distributed in the economy, which can never be reduced? Systematic, isn't it? It's called here systematic risk, uniformly distributed risk, right? And then we have this one, the upper one, which is reducing as the portfolio grows. The one that is reducing as the portfolio grows. The one that is reducing, what name? Unsystematic now. Unsystematic. If you remember very well, ladies and gentlemen, we gave this unsystematic risk some other word, some other name. Is there anybody who can remember another name for unsystematic risk? Unsystematic, diversifiable. I love that. Diversifiable. You can diversify this risk, diversifiable. Non-uniform, I love that. Or company specific. It's also called company what here? Specific risk. Company specific risk, or diversifiable, etc. Unsystematic risk is that risk which keeps on fluctuating. It is that part of a business risk that can be minimized, that can be diversified. So we are saying that at CAPM, ladies and gentlemen, because these investors are risk averse, they are going to reduce their risks to the very best that they can. They're going to reduce their risk, in this case here, up to this level, because that they will do. Because they are risk averse, they shall strive to work with this portfolio. They shall strive to work with this portfolio combination of assets here, which gives them the basic minimum. So in that case here, ladies and gentlemen, systematic risk is the environment of CAPM. This is the CAPM environment. 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 I'm repeating again. It assumes that all investors are risk averse. They will diversify the diversifiable risk totally. They shall be able to eliminate this risk. Actually, their objective would have been, the objective of these risk-averse investors there would have been to diversify the entire risk, to remove the entire risk here to zero. But you see, that is not possible. Why? Because we've got this hard rock. We've got this hard rock. You can never go below this hard rock. So in this case here, the only risk which will be affecting these risk-averse investors under CAPM is a systematic risk, is a systematic risk. Now, ladies and gentlemen, please listen and listen to me very well. Tell us there that systematic risk is measured is measured using beta, is measured using beta factor, is measured using what here? Beta factor. So beta factor is a measure of who? Systematic risk. Beta factor is a measure of systematic risk, is a measure of systematic risk. Now, ladies and gentlemen, I would want you guys to listen and listen to me very well. You are the ones who told me of some very important equation called the portfolio equation. Remember, portfolio equation uses standard deviation. This one here uses standard deviation to measure risk. It uses standard deviation to measure what here? To measure risk. When you talk of portfolio equation, it uses standard deviation to measure what here? Risk. And that is why we said that our returns of the portfolio will always be equal to risk-free plus expected returns of the market minus risk-free multiplied by standard deviation of the portfolio all over standard deviation of what here? The market. This is what we call the portfolio equation, and I don't mind you guys writing this down, and then if possible, please come and highlight this. You highlight this, please use, don't bring politics here, but I always love yellow highlighters. I always love yellow highlighters. Anything that is not a yellow highlighter is not a good highlighter for academia. It's not a good highlighter for academia. No, it's not about politics, really. It's not about politics. This one I've always been telling you from actually over 7 years ago. Right? When I open a book, in this case here, that has got yellow highlighters in between, I really feel nice. I feel very nice. What I do not know is whether when you see people wearing yellows outside there, whether you feel nice, but that is, I don't know. For me, I'm not into politics. I don't even have that time, really. I'm not into politics. I don't have that time. It's very visible, yes. It's very visible. It's very visible. The land of bananas. So you think yellow. We shall overcome. We shall overcome. No, don't bring politics here. Totally. In my class, I want to bring politics totally. Great. So this is a very important equation to me. And then now I'll be able to introduce below here something that is even more important compared to the portfolio equation. I'll be able to introduce what we call the 𝗂𝗂𝗄𝗲 returns, but this time around I'll call it 𝗂𝗂𝗄𝗲 returns of a security. 𝗂𝗂𝗄𝗲 returns of a security. So 𝗂𝗂𝗄𝗲 returns of a security, ladies and gentlemen, will take everything just like what we have here. So we shall be talking of returns over the risk-free asset. So risk-free asset plus the risk premium, plus the risk premium, plus the risk premium, which is ERM minus risk-free, multiplied by, can somebody tell me what to use outside here? If it's 𝗂𝗂𝗄𝗲. If it's 𝗂𝗂𝗄𝗲, can somebody tell me what to use outside here? Beta, because 𝗂𝗂𝗄𝗲 uses systematic risk. Systematic risk is measured using beta, and that is why here I'll come just like here. I'll talk of beta of a security all over beta of the market. Beta of a security all over beta of the market. For 𝗂𝗂𝗄𝗲, we like using security because 𝗂𝗂𝗄𝗲 can be used in this case to also evaluate individual securities. It's not really tied to a portfolio, no. 𝗂𝗂𝗄𝗲 can be used to evaluate securities, including what here, when those securities are combined together to give us a portfolio. So could you kindly then write here, this RS stands for what? Required returns of a security. Please write there in full. RS stands for required returns of a security. Required returns of a security. RF stands for risk-free rate of return. Risk-free rate of return. Risk-free rate of return. Risk-free rate of return. And then we have ERM. ERM, ladies and gentlemen, ERM in this case here stands for expected market returns. Expected market returns. Expected market returns. And then we have this beta S. This is beta of a security. Beta of a security. And then we have BM. which is better off the market, better off the market, better off the market, better off the market, better off the market. And then there is one thing that you must always bear at the back of your mind, that beta of the market is always equal to what? To 1. Beta of the market is always equal to 1. You may forget about everything else, ladies and gentlemen, but you shall never forget about beta of the market. Beta of the market, beta of the market, beta of the market, beta of the market. Great. Great. So once you write up to here, could you kindly give me some signal? You tell me, Mwalimu, you are ready to continue. You say yes, like I can see so many yeses. And then also, we shall also, ladies and gentlemen, today give a good present to that person, that student who has never ever worked in their entire life. Hajaipata mshahara. Inafaa pia tumpatie zawadi leo. Inafaa pia tumpatie zawadi. Yani hajaipata mshahara. Yani mwanafunzi tu throughout, hajaipata mshahara, hatuwezi kumwacha hivyo pia. Hatuwezi kumwacha hivyo peke yake. Hapana. Ule hajaipata, yani hujaipata mshahara. Leo pia lazima tumpatie zawadi, lazima. Na huyo tutamchangia sisi wote. Huyo tutamchangia sisi wote, sio mimi peke yangu. Yeah, beta of the market is equal to 1. Beta of the market is equal to 1. Beta of the market is equal to 1. Huyo tutamchangia kila mtu so moja moja. You can see says he is willing. Kila mtu so moja moja. Huyo atapata 7,000 sasa hivi. Huyo atapata 7,000 sasa hivi. Leo naona nimeanguka. I pledge 200, you can see. Yes. 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 Na usidanganye. Ukidanganya Mungu anakuona. Wewe umekuwa tu full-time student. Full-time student. Hujawahi fanya kazi kabisa and you really want some cash today. You really want some cash today. It's only one student. It's only one student. Mimi nitapeana 1,000. Hao wanadanganya, wengi wanadanganya. Turudi hapa, tuseme na tukiendelea kutafuta nitamjua. Tuseme CAPM returns equals risk free plus into brackets hapa ERM minus risk free into beta of a security. Sasa nawauliza swali, hii beta M imeenda wapi? Beta M imeenda wapi? Thank you very much. Beta of the market equals what here? Equals 1. Beta of the market equals 1. Beta of the market equals 1. This is that equation that I would want you guys to highlight. Don't highlight it in red or pink or whichever, in yellow. Please highlight this equation. This equation is so important to me. It's 1, and anything over 1, I like that, Lucy Alan. Anything over 1 is always what here. So please let me know whether you guys have been able to highlight this thing in yellow. And I will be able to buy all of you yellow highlighters. I have to buy each one of you a yellow highlighter. Come on, really, I have to buy each one of you a yellow highlighter. You're very important. Great. Great. So I would want us to straight away go to November 2016. November 2016, question number 2C. 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 Are we there? November 2016, question number 2C. 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 Akiangalia wanafunzi waja print hizi papers, consultant anauliza, where do I get past papers? Ama consultant ni mwanafunzi mgeni. Hebu mtumie link, hebu mtumie paper kwanza. Sorry ya, nimekumbuka ya. No, you're not late. Don't worry. You'll overcome. Hebu kwanza mtumie hiyo paper kwa nini kwa WhatsApp very fast. Once you do that, please let me know. November 2016 question number 2C. November 2016 question number 2C. Is there somebody who has been able to send that particular sitting? Hata mngekuwa wanafunzi wazuri mnanunue kitabu mara moja. Kuna question na kuna solutions. It's only 1,000 shillings. 1,000 shillings. Unapigia msichana simu huyu. Yeah, Cyrus has already shared. Yeah, page number, it's page number 55 actually. Page number 55. Thank you very much. So it's question number 2C. Inasema Mary Chege has been investing in shares of various companies quoted on the Securities Exchange. Currently holds a portfolio of shares in 4 companies. So we have W, X, Y, and Z. The following has been provided. So they have given us companies there, number of shares held. We have equity beta. So they have given me beta. This is a systematic risk question. They have given me market price per share. They have given me expected return on equity. The current market return is 14% per annum. And the treasury bills yield is 9%. Can somebody tell me this treasury bills yield of 9%? What does it in this case here represent to us? What is it to us? This treasury bills yield. Thank you very much. Anything to do with government is always what? Yeah, risk-free. Anything to do with government is always risk-free. Vile siku hizi maserikali zimekuja wakora, unafanya nao biashara, wanakosa kulipa. But zile siku za kitambo ama serikali kama za Amerika, wapi, anything to do with government does not have any risk. So ukiona treasury bills, unajua straight away, you need risk-free rate per annum. So they want us to give them the risk of Mary Chege's portfolio relative to the market. And then we are told, number 2, to determine whether Mary Chege should change the composition of her portfolio. I would want us to start with Roman number 2. Please indicate that it's Roman 2 nicely. Roman 2 nicely. And then please give me a title there. Change the composition. Change the composition of the portfolio. Change composition of the portfolio, just for your future revision. So for us to be able to know, ladies and gentlemen, whether this lady needs to change the composition of her portfolio, we need in this case here to measure the efficiency of the portfolios. We need to measure the efficiency of each individual security. We need to measure the efficiency of each individual security. And how do we do this? Step number 1, give us CAPM returns. Give us CAPM returns of each security. This is the first thing. Give us CAPM returns of each security. Give us CAPM returns of each security. And fortunately, we know the formula of CAPM returns. We know that CAPM returns will always be equal to risk-free into ERM minus risk-free multiplied by beta of the security. I have got 4 of them, and I'm going to compute the CAPM returns of each security. So we start with the first one, which is W. So for W, is there anybody who is able to pick the risk-free rate of return from the question? I'm following this. I want to plug in. Is there somebody who can see the risk-free rate, the T-bill rate, the 9%? Thank you very much. The 9%. How about the expected return of the market? Are you able to see current market return of 14%? 14%, thank you so much. 14% minus again risk-free, which is 9%. Multiply this by the beta of W. Is there anybody who is able to see beta of W? There are students who really hate AFM. For whatever reason, and I don't know, and this is really the best subject, for whatever reason, akisikia beta, yeye anasikia hivi. Akisikia beta, anasikia hivi. Yaani akisikia beta, yeye ana feel hii beta. Unaona hii? Na imagine sisi tunaongea kuhusu beta mzuri hii ndio beta sisi tunaongea. Unaona? Ya beta factor ile ya kumesha systematic risk. So sisi tukisema beta hapana chukia sana FM. No. FM ukitaka kupenda, you must always smile. And when you smile at it, it'll smile right back to you. Right back to you. So beta, they are telling me beta in this table, ladies and gentlemen, they are telling me in this table, when they look at this table very well, they are telling me that the equity beta of W is 1.12, is 1.12. So could you kindly then give me the final answer? So you say 9 plus, open brackets 14, minus 9, you close. Usikaseme equals. Usikaseme equals kwanza. Ukishasema close, sema times 1.12. Sema times 1.12. So I'm being given a figure of 14.6. 14.6, 14.6, 14.6. Great. 14.6, 14.6, 14.6, 14.6. Yes, percent. Thank you so much. Great student Irene Odeni is asking, why are we not using 18? Thank you so much. Thank you so much. Are you able to see that the expected return of W is 18%? Somebody, the expected return on equity of W. Are you able to see it's 18? Somebody there? Is there somebody who is able to see it's 18? Is there anybody who is able to see it's 18? Yes. Yes, it is 18. But you see that is expected return of W. But what does the equation want as here Irene Odeni to do? They want us to use ERM, which is normally common for each one of them. It doesn't keep on changing. This ERM will be the same throughout. The returns of the market will be the same for W, for X, everything, right? The column of 18, whatever, that column will be used a bit later. So Irene, are we together? Irene, are we together there? Irene, are we together there? Thank you so much. So then very fast, come and pick the one of X. So for X, what do we have? You see the risk-free does not change. Even the returns of the market will not change when you pick up a new security. That will remain at 14%, minus still 9%. But now the risk profile of X changes. The risk profile of X changes. It changes to what here? Somebody, the risk profile, which is beta, it becomes 0.89. Thank you so much. 0.89 like that. So could you kindly give me this answer? Could you kindly give me this answer? 13.45. 13.45 like that. Thank you so much. Thank you so much. So from there, ladies and gentlemen, go to Y, go to Y, go to Y. So Y, what do we have? Risk-free still remains. Plus ERM is 14%, minus 9% into beta of Y. Beta of Y, I can see beta of Y is 0.7, like that, which will end up giving me what figure, somebody? 12.5%. 12.5%, remember, percent, like that. So from there, we have the last one, which is Z. So Z, every other thing will remain the same. It is 9% plus 14% minus 9% multiplied by beta of Z. And the beta of Z is 1 point what here, somebody? 1.6. Thank you very much. 1.6. Sasa wacheni waambie kitu mzuri hapa. So many students will be able to write this nicely. But so many students are not good with body mass. So they always end up getting what are wrong answers here. And that is why I am here today to assist you. If you're not able to get our answers here, please scream loudly. Scream loudly, right? If you're not able to get our answers here, don't fear anything. Come and tell us, hey, you know what, gentlemen and ladies, I'm not able to get the correct answer. And we'll be able to assist. Yeah, and the very best way, ladies and gentlemen, of getting us to really see that you have an issue. You don't even have to write so much there. There is an emoji there that cries tons and tons of what here? Tears. You simply put it up. Once I see it up, I know there is a student of mine who has an issue. Great. So can I continue now after this? Can I continue? Can I continue? Yes. So we've been able to get CAPM returns of each security. Now from there, ladies and gentlemen, I'll go a notch further. This notch further, which is the last step, is to come and calculate. So last step here, calculate. There are only two steps. Calculate the Jensen's alpha values. Alpha values, that is profitability indices of each security. This is the second step. You come here and calculate for us the Jensen's alpha values, profitability indices of each security. Profitability indices of each security. Profitability indices of each security. Now the question is, how do we get this Jensen's alpha value? Alpha value of any security, you will be taking expected return of the security minus CAPM returns of each security that you found here. So anytime, ladies and gentlemen, they want you to calculate alpha, this is alpha of each security. You'll be taking the expected return of the security minus the CAPM returns of your security, like that. Great. Now from there, we shall go to each one of the securities that we have here, one at a time. So we shall start with W. So is there somebody who is able to see the expected return of the individual security, W? Expected return of the individual. So Irene, I hope now you're able to see your 18%. Irene, I hope you're able to see your 18%. So we have 18% here minus the CAPM return of W. CAPM return of W, you guys got 14.6 like that. We got 14.6. So who is able to give me the alpha of W? They're telling me it is 3.4. It is 3.4%. It is 3.4%. So from there, we have the 1 over X. So for X, ladies and gentlemen, I'm interested in the return that I will get from X. From X, what return will I get? Expected return of X is 23%, minus CAPM returns of X. CAPM returns of X, we have 13.45%. Is there somebody who is able to give us this figure? They're telling me this, that the final figure is 9.55%. 9.55%. From there, we go to Y. So Y, I'm supposed to take expected return of Y. The equity return of Y, if you have got good eyes, you'll be able to see the good return. Now, this expected return of Y is, somebody should be able to give me this answer. Somebody should be able to give me this answer. For Y, is there somebody who is able to see 11%? Thank you so much. How about the CAPM return of Y? It is 12.5%, like that, which will end up giving me what figure? This gives me negative 1.5%. From there, we go to the last one, which is Z. So for Z, I would really want you guys to give me the expected return of Z. Thank you very much. They're giving me answers. You guys are great. I can see Michelle. I can see Kips. Thank you very much. 𝗖cie, my friend, tells me that the expected return of Z is 17%. Expected return of Z is 17%. Minus the CAPM return of Z, which is what here? Which is 17%. Which will end up giving us what here? 0, 0, 0. So, ladies and gentlemen, all of us, first of all, are we really together up to here as pertains what here the Jensen's alpha value? Are we together really? Are we together, ladies and gentlemen? Thank you so much. Please feel free to say no. Feel free to say no. Feel free to ask what here questions. Remember, for the number of years that I've taught, ladies and gentlemen, I'm just as good as a trained teacher, and I've attended so many TOT, trainer of trainers sessions, and I know that there is no way I'll ever laugh at any of my students. Never. I'll always get out of my way to try my best to do explanations here until all of us are really in the same water boat. It's good to know that all of us are okay. Now, ladies and gentlemen, I can see that WX are profitable. We can see in this case here, their profitability indices, they're here. Any security which is profitable, whose alpha value is positive, will always be called super efficient. Super efficient. Super efficient will be called what here? Super efficient. Super efficient. So this one here, ladies and gentlemen, is a super efficient security. The same case here with what here? Super efficient. The second one is also super efficient. How about this one here, which is negative, loss making? So if it's loss making, it will be what here? Somebody inefficient. It will be inefficient. 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 And the one, ladies and gentlemen, that is just able to break even zero. The one is that is just at the break even zero profit. We call it what here? Just efficient like that. Efficient like that. And I've seen some 2 questions here. Please allow me to respond to them. I've seen in this case here. I've seen here. But why should we calculate Jensen's alpha? Quite a nice question. Why are we calculating Jensen's alpha? Remember, this person is asking us whether she should change the composition of her portfolio. We can only, ladies and gentlemen, in this case here, mention that the portfolio that we have is so good if we do not have an inefficient security. If you have a security which is loss-making, inefficient, then the portfolio is never optimal. Like here, do we have an inefficient security? Yes, we do. So then what should we tell 𝗖𝗂𝗂𝗲𝗂𝗲𝗲𝗲 that, hey, your portfolio is not the very best. You will still need to do what you have to make changes. If possible, get away over discarding this bad security, and then you bring in a profitable security. So in this case here, should 𝗖𝗂𝗂𝗲𝗂𝗲𝗲𝗲 change the composition of her portfolio? In conclusion, you're saying yes, 𝗖𝗂𝗂𝗲𝗂𝗲𝗲𝗲𝗲 should change the composition of her portfolio because we have an inefficient security. Because we have an inefficient security. Because we have an inefficient security. So 𝗖𝗂𝗂𝗂𝗲𝗂𝗲 should change the composition of her portfolio because we have an inefficient security, into bracket, security who? Security Y. Inefficient security called security what here? Security Y. Very good, Sharon. Is the alpha value another name of profitability indices? Yes, yes, yes. James Kia anauliza, what if we are not given expected returns of securities? Thank you for that question. If you're not given expected return of the securities, I know the kind of question that this gentleman is asking. Is a question where they'll give you, for example, some parameters. They'll give you, for example, that this security at the beginning of the year is worth 10. At the end of the year, it's worth 13. So you'll be able to calculate, in this case, that increase in form of a percentage. You should be able to calculate, ladies and gentlemen, expected returns yourselves. And I'll be able to show you that. For now, for purpose of simplifying and ensuring that I drum home this concept of Jensen's alpha value, please allow me to work with a situation that I am given expected returns. Right? Remember, in teaching, we have to start from the known to the unknown, like that. Then there was a gentleman here who asked here, great, welcome, who asked here, there's a gentleman who asked here, I never understood this question very well. In such a question, what probes you to use CAPM returns instead of RP? One and the same, really, only that as I explained here, I told you, as I explained here, that CAPM, unlike the portfolio, we have portfolio question And then we have got this 𝗂𝗄𝗃 returns. Unlike, ladies and gentlemen, in the portfolio equation, 𝗂𝗂𝗃 as a model can be used here to compute required returns for even individual water securities. But even if you were to put the name 𝗂𝗂𝗃-RP, 𝗂𝗂𝗃-RP, you'll still get the same answers. You even get some books, they're not even differentiating. They don't differentiate. So whether you use 𝗂𝗂𝗃-RS or 𝗂𝗂𝗃-RP, that is neither here nor there. You can use any and still will be what here? You'll be okay. You'll be okay. Now, can we kindly look at part 1? So part 1, they want us to give them the risk of Mary Chege's portfolio. Please underline for me the word risk. 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 Determine the risk of Mary Chege's portfolio relative to the market risk. So I know that risk could either be measured using standard deviation, could be measured using standard deviation or beta. Right. In this question, I can't use standard deviation. I'm going to use what here? Beta. I'm going to use beta. And remember, they want me to measure the risk of the entire portfolio. The risk of individual securities has been given. The beta factors of the individual securities have been given. So they want me now to consolidate them, to put them together. So in short here, in short here, in short here, in short here, they want me, ladies and gentlemen, to come and give them. They want me to come here and give them, that's Roman 1. They want me to come and give them beta of what here? The portfolio. They want me to give them beta of the portfolio. So how do I get beta of the, in situations where I'm given betas of individual securities. Like now here, they have given me beta of W. They have given me beta of X. They have given me beta of Y. They have given me beta of Z. I'm supposed to come and do what here? Consolidate them, but not in a very stupid way like this. You can't add them directly there, and we know that the investment amounts were not the same. So it has to be weighted averages. So you must introduce the weights. So come and talk of weight W here, talk of weight X there, talk of weight Y here, talk of what here, somebody weight Z like that. So the most important thing, ladies and gentlemen, when they talk of beta of a portfolio is a combination. So you're combining betas of the individual what here securities. But now using the concept of what here? The weights. Using the concept of what here? The weights. Using the concept of the weights. So please mention there somewhere there that like now these, you can call it WJ because there are many. This stands for the weights like that. Now I would want a student, a good student for that matter, to take a step of faith and give us the weight of W. I would want to see whether there is anybody who can give us the weight of W, the weight of W. Now me have seen your question, the weight of W. Caro, I haven't seen your question really. I can only see Y, unless the question is up there. Right, 0.2. Thank you so much. Thank you so much. 0.2, 0.2. Thank you so much. Thank you so much. Thank you so much. Thank you so much. You guys are bright. You guys are bright. Ladies and gentlemen, I remember one day when I was doing computer programming, VB6, Visual Basic 6, all the time I could make a few mistakes here and there. My teacher used to tell me, you know what, Joshua, you've made what we call an ID10T error. Every time, that's what he used to tell me. ID10T error. And I went like that for over 9 months without knowing that this fella, who is also an idiot, has been, in this case, here telling me something bad. He's been calling me an idiot. I felt very bad. I felt very bad. But I chose in this case here to use this for learning purposes. For learning purposes, for learning purposes, because, ladies and gentlemen, in finance, there is always something you're supposed to know. There is something you're supposed to know. How do you get those answers? Now, look at this, ladies and gentlemen, look at this. You see, we have W, we have X, we have Z. They have given us the number of shares. They have given us number of shares. Number of shares, they have told us here we have 10,000. Here we have 15,000, 15,000. Here we have 15,000, 15,000, 15,000. And then Z, we have 10,000, 10,000. I know the mistake that so many students do. They'll come and add all these, and then they start getting proportions like 10,000 divided by 15,000 divided by. You can't do that when you have market price per share. We have market price per share. The market price per share has been given there as 130, 100, 90, and then we have 160. So please, could you kindly come and give us the total value here? Total value. How do we get total value? We normally take the nose times market price per share. Nose times market price per share. Nose, tata, yes. Number of ordinary shares times market price per share. Please give me these answers now. 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 Give me these answers now. So please try to use separators. Try to use separators in your answers for me to be able to pick them very fast, like 1.3 million or 13 million. Try to use separators. Separators are very important. 1.3 million. Thank you very much. So 1.3 million. These are the separators, right? How about the second one? Will the second one be 1.5 million? Will the second one be 1.5 million? The second one, 1.5 million. How about the third one? How about the third one? 1,350,000. Try to use the separators. 1,350,000. And then the last one, what do we have? The last one, what do we have? The last one, what do we have? $1.6 million. Thank you so much. 1.6 million, like that. So then could you kindly come and give me the total value now? The total value. The total value is 5750,000. 5750,000. Now, out of this, I'll be able to extract my weights. Out of this, I'll be able to extract my weights. So you take like this divided by this. Give me an answer in 2 decimal places. Give me an answer in 2 decimal places. Give me an answer in 2 decimal places. So decimal tells me 0.23. All right. And then now we have this divided by this. Give me an answer, 0.26. Thank you very much. Thank you very much. And then we have this divided by this. This divided by this. 0.23 again, right? 0.23. Thank you. Thank you so much. And then we have the last one, which will be this divided by this. The last one will be 1.6 divided by, which gives me 0.28. Thank you very much. Now, ladies and gentlemen, what have we learned out of this? What have we learned out of this? If, for example, you're a great lady here who has a great husband at home, after you finish this from your study room, you finish learning this thing from your study room, and then outside there you meet your husband. Hey, what have you been learning today? Will you tell my husband, mind your own business? Because you never understood. So what have we learned regarding calculations of weights? We should always be getting the weight using values, not number of shares. We should always be getting weights using what here? Value, not number of shares. Unfortunately, when I asked you guys to do this for me, you were able to give me these answers automatically. I don't know how you guys did it. There is nobody who did the ID10T error. Nobody. Nobody did that. Nobody. Nobody. Thank you so much, Consolata. If we have market price per share, we have to calculate the total value to find the weight. I can't put it any better. I can't put it any better. Lucy Allen, use the given market price to calculate the value. That the market prices given there are not flowers. They are not flowers. They have to be used somewhere. They have to be used somewhere. And then your husband will respect you forever. I mean, they'll know they married a very serious lady. They need to bring more cows. The extra cows to be brought to me because I'm the one who is teaching you. Great. So now that we have, ladies and gentlemen, these weights, please come and plug them here for you to give us what we call beta of a portfolio. Beta of a portfolio. Yes. Consolata, she's asking a very good question. Does it mean that if we do not have a market price per share, we use the numbers? Yes. Use the number of ordinary shares. If you don't have MPS, use the number of ordinary shares to calculate weights. But I've never seen it. I know at the end of the day, the weight will really be a function of how much did I invest in this security? How much? You can buy so many shares of a company which are worthless. I can buy very few shares of a company, but because the market value is too high, I invest more. So the weight, the level of importance will always be based on how much, what is the value of my security vis-a-vis the others in the portfolio. So then we have the weight. Weight of W is 0.23. 0.23. How about beta W? Are you able to see beta W? Are you able to see beta W? Are you able to see beta W? It's written there, equity beta to scare you. To scare you. It's written there, equity beta to scare you. So 1.12, if you're together. 1.12 plus weight X, which is 0.26 times beta X. Beta X, ladies and gentlemen, beta of X is 0.89. 0.89 plus, ladies and gentlemen, plus, we have the next weight there. The next weight is 0.23 multiplied by 0.7, multiplied by 0.7, multiplied by 0.7. And then we have the last one. The last one, ladies and gentlemen, is 0.28. The last one is 0.28 times the last beta there, the last beta which is given as 1.6. So Naomi is giving me a figure of 1.098. Thank you so much. 1.098 like that. 1.098 like that. Thank you very much, Godon. Michelle, you're always shining. You're always shining. Thank you very much. So beta of the portfolio is 1.098. Now listen, ladies and gentlemen, listen here. Listen here. They wanted us to give them the risk of Mary Chege's portfolio relative to the market. There is something that you guys have forgotten here. There is something that you guys have forgotten. I'm so sure that there is nobody who will be able to remind us the value of the beta of the market. Is there anybody who is able to remind Mwalimu what the beta of the market is? What the beta of the market is? Let's see. Beta of the market, 1. Thank you so much. Beta of the market is 1. And what do we have here? The portfolio that Mary Chege has 1.098. Has 1.098, which is more than what here, somebody? More than 1, which is more than 1. So it means that Mary Chege's portfolio is a high risk. Is a higher risk. So you can write there that because Mary Chege's portfolio has a beta which is more than 1, more than the market portfolio risk, it means that Mary Chege's portfolio is high risk. I.e., Mary Chege is a risk taker. Mary Chege is a risk taker. Mary Chege is a risk taker. Into bracket, aggressive investor. Aggressive investor. She is an aggressive investor. In terms of portfolio management, anybody who assumes a portfolio that has got quite a high risk, we call them risk takers or aggressive investors. What if, for example, ladies and gentlemen, we had beta of Mary Chege's portfolio being 0.7. So 0.7 is less than what here, somebody? 0.7 is less than 1. So meaning that this time around we would have said that Mary Chege's risk is, or rather portfolio is low risk. Low risk. And if it's a low risk, what does it mean of a risk appetiteness? Automatically a risk appetite will be what here? Risk averse. Risk averse. Risk averse. Risk averse. So in this case here, say, this student tells me to repeat, no problem. You see, we are saying that this is 1.098. It's more than what? 1. Meaning that Mary Chege's portfolio, Mary's portfolio is what here? Is a high risk. Is higher. Is high risk. Meaning, ladies and gentlemen, that Mary is a risk taker. Mary is a risk taker. In other words, if she's a risk taker, we shall be calling her what here? An aggressive investor. Otherwise, if it was low risk, we would have said that this investor is what here? Is defensive. If they are not aggressive, if they always go for low risk portfolios, we call them what here? Defensive. They defend their positions quite a lot. You tell them, hey, let's invest in this. Wanasema, no. Everything over there is no. They are not risk takers. They're not risk takers. Any question now? Any question that you would want Mwalimu to tackle? Any question? Any question? Any question? I'm aware that I'm quite fast. But whenever you feel that, hey, the speed is too high, don't always feel free to stand on the road and say, hey, flag me down. But I believe that especially for the students who are not doing any other thing, for the students who are 100% in class here, who have got calculators here and there, I'm so sure they are really following. But if you are trying to multitask, because I'm so sure that there must be somebody here because their cameras are off, I'm so sure there must be somebody who is eating ugali and studying at the same time. Those things can never work. I joined late. Are you able to redo the first step, Macharia? Please allow me to give you the video of this because you came in late, Macharia. If I start again, it will distract me from, I would have really loved, but I've now wrapped most of these things. I can't start again. Macharia, please bear with me. Watch this video immediately after this class. I hope that is okay, Macharia. Yeah, keeps you must be eating ugali, which is very bad. Thank you, Macharia. Keeps you must be eating ugali when you are doing what here. The only thing I allow my students to do is to drink coffee. Any other thing, no. It's a distraction. Especially if you're a man, men, we can't multitask. At least a lady can do a few things here and there. Like there is one that I was teaching the other day. Somebody. Akona twins na anasoma vizuri sa. Karo. Thank you so much. Now, ladies and gentlemen, mention exercise there. Now, if I was an examiner, I wish Kasneb can give me a chance of setting an exam this semester. I wish. But nowadays they say I'm old. Like these young men who can set very hard things. Old men can't set very nice things. Now, if they were to give me this, what I'll do to at least ensure that many students don't go to canon as pertains to passing of exams, what I'll do, I'll come and give them states here. States there, right? I'll come and give them probability. 0.3, just an easy question, but most of them will not be able to tackle this. Then we have returns of security J, 10, 12, 18. Then we have returns of the market. So we have here, for example, 13 or 19, 21, like that. All right. All right. So then what I'll do, ladies and gentlemen, here is to come and ask my students here to do something very easy. Very easy. I'll come here, required. Number one, I'll ask them to calculate the 𝗂𝗂𝗄𝗲 returns of J. And then number two, calculate the alpha value of J, alpha value of J. No, Kentonio, you can't have a negative beta. You can't have a negative beta. Very good. Keeps not eating anything, is concentrating very well. So they want us to calculate 𝗂𝗂𝗄𝗲, returns of J, and then number two, calculate alpha value of J. Ah, how did I forget this? Very important, yes. Please risk-free. I'm sorry for that. Thank you so much. Risk-free is 5%. Risk-free is 5%. Risk-free is 5%. So what do you think of such a question? Do you think you can score all the marks really here very well? Do you think you can score all the marks here very well, easily? Easily. Asesi says yes. Let's do this together. Have you been able to put down the question? Have you finished putting down the question? Yes, thank you very much. Great. So then the very first thing that I'll do, never panic. I don't panic as a man. Even a lady, a good lady should never panic. So why should I not panic? These guys have even, in this case here, led me. They have told me they want me to give them the 𝗂𝗂𝗄𝗲 returns of J. So then the first thing that you will do is to write down the formula. So the formula, we have what we call risk-free into brackets here, ERM minus risk-free multiplied by beta J. It doesn't have to be beta S. Depends on the security. It's beta J. Ah, now I see something nice. I may not get all the marks. But I'll end up, ladies and gentlemen, getting so many marks without even knowing what I'm doing. Why? Like now here, I can see this metric wants me to get ERM. This metric wants me to get ERM. ERM stands for expected market returns, But what I can see here, they have given me are the actuals, and they are fluctuating. They are different. So because they're different, I need to come and average them. So could you kindly give an advice to me? Tell me, when these returns are behaving like this, what should I do to get an average, to get an expected value? What should I do? Yes, data, like what they're telling me. They're telling me, Mwalimu, take the actual returns of the market times what your somebody probabilities, right? And then you sum them. So my expected returns of the market then will be equal to, the actual return here is 13 times 0.3 plus 19 times 0.2 plus 21 times 0.5, like that. So could you kindly give me an answer there? Felicitas tells me it is 18.2. It is 18.2, like that. So is there somebody who is able to confirm that this 18.2 is correct? Thank you so much. And then I know that the market portfolio is the bedrock of all other portfolios in the market. And I'm really concerned about its risk. When I'm concerned about its risk as an individual security, then it will be important for me to calculate the standard deviation of the market. It will be important for me to calculate the standard deviation of the market. So could you kindly tell me the formula of getting the standard deviation of the market? Could you kindly tell me the formula of getting the standard deviation of the market? Is there anybody who is able to remind me? You know, market portfolio is the best portfolio in the market. Right? It's an efficient security. We shall be seeing very efficient security in the market, and it is the one that guarantees optimal returns in the market. So it will be very important for me to really look at the fluctuations, the variability of what these returns. It will be very important, yes. So could you kindly then go ahead and give me the formula? If you give me that formula correctly, then I'll be able to give you a present. If you give me that formula correctly, I'll be able to give you a present. Is there somebody who is able to give me this formula correctly, really? Is there anybody who is able? So deviation between two securities? No. The security here is one, is market, Carol, but thank you very much for trying. Thank you very much for trying. Thank you very much for trying. The standard deviation over the market. I want to see whether there is anybody who will be able to remember this. One thing that for sure I will never forget, especially as somebody who is married to a Kalenjin. Nowadays I've started there, knowing language kidogo. So najua what we call Kiptorut. Kama kingine kanaka namna hii. Sasa angalia, lazima always ikuwe na square root. Always. Hata kama atashinda na anything else, lazima always ikuwe na square root. Always. You may not forget, you may not remember so many things, but you can never forget the concept of what yes. And then inside here now, I know it is the standard deviation of the market. Standard deviation means minus, means subtraction. So I need to come and talk of returns of the market minus the expected returns of the market. That is the deviation that I'm talking about. But remember that this deviation is so special to us. It has to be done what? It has to be squared. This deviation is so special to us. It will be having so many probabilities. So I need to come and multiply this with probabilities. And then, of course, I do what here? I sum like that. This is the formula of standard deviation of the market. This is the formula of standard deviation of who? The market. And now, ladies and gentlemen, the moment you give me this formula, really, the moment you will give me this present, these little ones are present, we shall overcome, Lucy, don't worry. You will get so many presents. You will get so many presents from me. By the time we finish this semester, everybody here will be a winner. Everybody here will be a winner. By the way, we forgot that student who really has never worked before. Na hisi pesa kwenda kula mandazi. Has never worked before. Hii ni pesa ambayo nataka iende ikuwe genuine case. Genuine case. Mwanafunzi mmoja tu ajaipata kazi, anataka tu pesa, na si pesa hivi hivi. Hiyo ni pesa ya mtu mwenye ako really needy. Nani yule mwanafunzi tuchague sasa? Tuchague sasa during our break. Tuchague sasa during our break. So tuko na Lea. Tuko na Lea. Tuko na Susan. Susan amerudia. Yeah, great. Tuko na James. Please usidanganye. Jemo usidanganye. Tuko na James. Yes. For exams top up. Huyu anakaa ni ukweli huyu. Sobrana for exam top up inakaa ni ukweli. Aya, Tosha. How will we ascertain it is the truth? Mungu anatuongoza. Lea, hebu tupatie namba yako haraka Lea hapa. Tupatie namba yako Lea haraka. Lea, tupatie namba yako haraka. Aweke video tumuone. Hapana. We don't want to torture them. Also, we are helping. 07 hiyo ni ya Safaricom kweli. 0759 71 74 46 71. Oh yeah. Abracadabra. Hii ni break time yani. Sasa ningewacha kurekodi pia. Tusikasome na hapa. Ideni hapa. So I hope hii formula umeshaikamata. So nitakuja niseme returns of the market ni 13. Hapa niseme ni 19. Alafu 21. Hizo ndio returns of the market. Returns of the market. Alafu niseme minus. Expected returns of the market. Expected returns of the market, is there somebody who can remind me the figure that we got up there? Expected return of the market, is there somebody who can remind me the figure? So expected return of the market doesn't keep on dancing. Expected return of the market doesn't keep on dancing. This one here automatically remains squared. times the probability, times the probabilities, which are these ones here. The probability are given here. So we have 0.2, no, 0.3. So we have 0.3, 0.2, 0.5 like that. So ukienda mbele, inakaa namna gani? So una open bracket, unasema 13 minus 18.2, you close and then you square times 0.3. Ensure that you are pressing these figures yourselves. Don't copy our figures. Don't copy our figures. Don't copy our figures. Don't copy our figures. Unasema open brackets 13 minus 18.2. You say squared times 0.3 and then you give us an answer. So Caro gives us 8.112. 8.112 like that. 8.112. Sharon has confirmed. Sharon has confirmed. Felicitas, Keeps anasema ya pili in 2848. Ya pili 2848 with a decimal there. Yun Keeps anasema ya pili 2848 with a decimal there. 2848 with a decimal there. Ya tatu J inaendaje sasa? Ya tatu J inaendaje? Ya tatu J inaendaje? Unasema lazima useme open brackets, Open brackets useme 21. O ya pili ni ya uongo. Ya pili we Keeps sasa ni aje? Keeps ni aje? Ukuweka bracket Keeps. Keeps shemeji yangu ni aje hapa. Unaweka bracket. Unasema open bracket 19 minus 18.2 you close. Alafu useme squared. Usikaseme equals. Endelea kusema times 0.2. So anasema ni 0.2128 with a decimal there. And then the last one. Wewe ngoja neke ngoja. Ya tatu ni 3.92. Asante sana kwa raise hiyo kitu ya square root. You see this square root is coming after you have gotten the summation. Square root is after you have summed. Square root is after you have summed. After you've summed. Look at this summation first. So you sum. Is there somebody who is able to give us this summation? Inakuja 12.16. So this 12.16, we normally baptize it some name. There is a name we call it. There is a name we call this 12.16. Is it variance? Variance. We normally call it variance. Kwa hivyo utakuja hapa woye, useme square root of 12.16 like that. Square root of 12.16. Square root of 12.16 hapa. Ukishapata summation, so kuja useme square root of 12.16. Inakuja na kuwa 3.4 what here? 3.4 something. 3.4 something. 3.49. 3.49. I'm so happy like that. I'm so happy like that. I'm so happy like that. So are we together up to here? Are we together up to here? Standard deviation of the market. Are we together up to here? Tuko pamoja. Tuko pamoja. Thank you very much. Now, ladies and gentlemen, remember as I do this, there is something that I would want you now to always remember. Something very important. Something very important. Something very important that I would always want you guys to remember. Something very important that I would always want you guys to remember is this. You see, they have told me to give them CAPM returns of J, which I've been able to say it is a risk-free plus ERM minus risk-free multiplied by beta J. But you see, the question has not given you this beta J. So I would want to see for a small present, for a small gift, I would want to see whether there is any student who will be able to remember the formula of BJ. This one is not for the faint-hearted. The formula for beta J. Beta J equals who? Beta J equals who? Great. So they're telling me that, Mwalimu, this is the easiest. To get beta J, we normally take covariance between J and M all over the standard deviation of the market squared. Anytime they want us to give them beta J, I must cough a little bit. I cough a little bit in an exam. So I say it's covariance between JM divided by the standard deviation of the market done what here? Squared. Covariance between J and M all over the standard deviation of the market squared. Please write this in full that this is covariance. Covariance like that. Now, when we talk of covariance, covariance means what? Covariance means the shared variance, the common variance, the shared variance. Now, my greatest ladies that I have here, there is nothing as risky as this word co. If you're passing, you can imagine somewhere, alafu usikie mtu amesema ati huyu Bila ama huyu Caro ama huyu Catherine ni co-wife. Hiyo jina ni dangerous. Dangerous sana. Dangerous sana. Hatari sana. Namaanisha there is something you're sharing. You're sharing a husband with this person who is making such allegations. Quite a sad thing. Very sad thing. So for us, when we talk of covariance, it's the common variance. The shared what here? Variance. The shared variance. The shared variance. The shared variance. I love this. So when they talk of shared variance, ladies and gentlemen, when they talk of shared variance, what do they want me really to know? It's very easy. When they want me to calculate the covariance between JM, what I'll do is to take the deviation of J, multiplied by deviation of M times probability, and then sum. So you take deviation of J. Yo, wamama ni wawili. Iko. Wamama ni wawili. Ni J. Yani nachukua sasa moja J, deviation yake. Alafu times deviation ya mama wa pili times probability like that. This is the covariance between J and M. And then when we talk of deviation of J, what do we mean? Deviation is deviation of returns. Deviation of returns. So we have returns of J minus ERJ. And then multiplied by the deviation of M. What do we have? We have RM minus ERM, like that, times what here? Somebody times probability. And then at the end of the day, of course, there must be what here? There must be summation. At the end of the day, there must be summation. At the end of the day, there must be summation. When I teach this for the very first time, I'm so sure there must be somebody who is very worried. But these are things that we love. Especially for the students that I've ever taught before, never ever try to always try looking for many things outside there. No, stick with my notes, study this, you will survive. So when you do something like this, go on, later on, look at this same question, solve it, seeing the answer there, solve it yourself. You'll go places, Master what we do here in class. So then I would want you guys to give me the last thing as I embark on finishing this. I would want a good student to calculate for me the expected returns of J. A good student to calculate for me the expected returns of J. Is there a good student who can calculate for me the expected returns of J? Let me give you 1 minute and see whether they'll be able to give me this expected return of J. They're saying 3. What a lie, Irene, today. Irene, today you have lied to me. You've lied to me. I don't know why. You've lied to me. But I know what Irene did. Irene took the tata moja. But I said tata. So expected returns of J, I'm picking the actual returns of J times the probabilities, and then I sum like that. So the actual returns of J are here. I can see it is 10 times 0.3 plus 12 times 0.2 plus, we have 18 times 0.5. That is how I will be able to get the expected return of J. So is there somebody who can give me this figure? They're telling me whatever it is 14.2 what here, 14.4. So what I don't know is whether all of us are able to see this figure. What I don't know is whether all of us are able to get that figure. All of us, are we able to get this figure? Really, there are students who are so quiet. Students who are so quiet. Thank you so much. So ladies and gentlemen, come back here. So here, so returns of J, what do we have? They're given here. Returns of J, we have 10, we have 12 there, we have 18 there, minus. So I'm picking the actual returns of J column, minus expected returns of J. You guys have given me a figure. Expected return is an mean return, same return throughout. So minus 14.4, 14.4, 14.4, like that. So please come here. How about the actual return of the market? The actual return of the market, they're here. We have 13, we have 19, we have 21 minus. Expected return of the market, if my memory serves me well, we had done this some time back. We had done the expected return of the market some time back. It was 18.2. So we have 18.2, 18.2, 18.2 like that, times the probability. Probability we have here 0.3, 0.3, 0.3, we have 0.2, we have 0.5. You guys are geniuses. Try in this case here to use your calculator very well. So you say open bracket, the first one, 10 minus 14.4 close times open bracket, 13 minus 18.2 close times 0.3. Give me an answer. Give me an answer. Kindly give me an answer. Kindly give me an answer. Kindly give me an answer. Caro says it is 6.86. I would want a second, especially from the students who have never spoken at all. 6.86. Thank you very much. Like David Shero, today you are so quiet. I don't know what the problem. David leo ama kuchoka. Usikubali kuchoka sana. Usikubali kuchoka sana. Fanya mazoezi. Fanya mazoezi. Kama mwalimu wako anapenda mazoezi. Kama sana nikimaliza class hizi, look at this. Very nice. It's a roller. Very nice. Right? Very nice. Yeah, great. Hii ni kiroll kama 20. Mimi unapoona lala namna hii, I can do perfectly 2 jobs and I'm good, right? Kwa sasa unakaa ufanye mazoezi, unakula starch mingi, nikifunza kama saizi unapata mwingine hata haoni kitu, haizi concentrate. Huyu anasema mwalimu, wewe sio mazoezi, we shall discuss later. So Lucy thinks perhaps mwalimu is using some drug. No, I cannot. Why should I spoil myself? I cannot. Roller is hard. You don't overdo. Sharon, don't overdo. Hii nataka tu kama 10 to 20. Na unafanya kama unaruka siku moja. Mpaka unazoea. Lakini uzuri wake itakufanya utakuwa very happy. etc. Unakuwa very happy. Lazima ufanye hii kitu, usipochunga mwili utakuwa na shida mingi sana. You can't reach your full potential. Kama uangalie mazoezi vizuri. How to reach your full potential. So wanasema ya pili ni negative 0.what here somebody? Negative 0.384. Negative 0.38. 2 decimal places. How about the last one? The last one Jabir anasema ni 5.04. 5.04. So please come and give us the total. Come here and give us the total. The total is 11.52. Give us the total, which will be 11.52. So this is your covariance between J and M. That is your covariance between J and M. Thanks, Cyrus. Thanks, Gilbert. Thanks to all of you for giving me these answers. Thanks. Even Desmond, today you are so quiet. We have Afm-Capm-Cpa. Leo hujaongea sana. So asante sana. So ladies and gentlemen, I would want us to do the last step. The last step in this particular case is the step of giving them the covariance, not covariance, but beta J. Who can remind mwalimu the formula of beta J? So beta J equals who? Beta J equals who? These guys are forgotten. Beta J, I'll cough a little bit. Beta J equals who? Beta J, thank you very much. It is covariance between J and M all over the standard deviation of the market squared. And the covariance that we have just obtained here is 11.52 divided by the standard deviation of the market that I've just forgotten. The standard deviation of the market, you guys gave to me this figure. Thank you, Naomi Faith. Great. Great. 3.49, eh? 3.49, 3.49, 3.49 squared like that. So could you kindly give me this value of beta j, 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 beta j will be equal to who? 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 Abracadabra, 0.95. 0 point. Now, could you kindly be very nice to me tonight as we go to sleep? Be very nice to me as we go to sleep. After having gotten this beta j, after getting beta j, what do you think will be the next thing to be done? What do you think will be the next thing to be done? Great. Huyu Karo anashikanisha sana. Ama Karo ni vile tumempatia pesa. Si Karo amepata pesa? Karo alipata pesa ama hakupata? Aya. Great, 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 great. Thank you so much. So wanasema, ladies and gentlemen, that we need to come and give them CAPM returns of J. CAPM, we must start with risk-free plus ERM minus risk-free multiplied by beta J like that. So is there somebody who can remember the risk-free rate? Is there somebody who can remember the risk-free rate of return? Is there somebody who can remember the risk-free rate of return? It's 5%. How about expected returns of the market? Somebody must have forgotten this. How about expected returns of the market? We got this up there. It is 18.2% minus risk-free, minus risk-free, minus risk-free, minus risk-free, minus risk-free. 5. Multiply by beta j. Is there somebody who can remember beta? Already we have it here. 0. What here, somebody? 0.95. Thank you very much. So using your body mass skills, could you kindly give me the CAPM returns of J? The CAPM returns of J. So from Winnie Julu, we have 17.54. From Winnie Julu, we have 17.54 like that. 17.54 like that. 17.54%. 17.54%. 17.54%. 17.54%. Great. So before we start running, there is one more thing we have to do. In Roman 2, there is one more requirement we must do. Which requirement is that? Which requirement is that? There is great. There is a requirement that we need there. This requirement is alpha. This requirement is alpha. This requirement is alpha. So come here and give us alpha j. Alpha j. So for alpha j, I would want to remain silent a little bit and see whether there is a student who will be able to get this alpha j correctly and tell us whether this security is super efficient, efficient, or inefficient. Let me see. 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 So you can see so far, I'm not seeing any man. I'm not seeing any man giving me answers. Most of the people that I'm seeing there, I don't know, and I see whether it's a man or a lady. Naomi is a lady, Susan is a lady. I think I also need really to find a way of motivating my great brothers here. Okemo, at least, the first one to give me an answer there is Okemo Bernard. I would want really my men here to talk really. Men to talk, kabisa. I would want men to talk. Hata kama unaongea uongo, wewe so long as unaongea. So alpha J, remember alpha J is expected return of J minus the Capm returns of J. So could you kindly give me the expected return of J? Is there somebody who can give me we calculate this up there. Expected return of J is not 3, no. Expected, the average, the one that you got by taking expected is 14.4% minus the Capm returns that you have just obtained here. Capm returns of J ni ngapi? Capm returns of J ni ngapi? 17.54, right? 17.54, which will end up giving me what figure somebody here? We have here minus 3.14, like that. So meaning that this security is inefficient or overvalued. It is inefficient or overvalued. If for example, your spouse today was to tell you, you know what? You are just overvaluing yourself for nothing. That is the worst kind of a statement that a spouse can tell you. That you are overvaluing yourself for nothing. Overvaluing means that you are inefficient. So ukisikia overvaluing, right? Inamaanisha inefficient. Emily, you're asking a question there, but I believe you've been able to give us what here? The alpha of what here? J. And here I'm giving you a very good way of remembering this thing. That if the security is inefficient, it means that the security is overvalued. Emotional damage. I love that. So thank you very much, ladies and gentlemen, to also motivate my